is the Infinity Summit Group. Truth, passion, success.
That was when we were not podcasting quite yet, just in one of our regular meetings, and then we'll try to get some of that same information to you guys. Now it's going to be kind of a repeat for you, but hopefully we can give the listeners some good info and tell them where they can find you.
Absolutely.
Heck yeah.
Appreciate you guys having me on.
Yeah.
Heck yeah.
Of course. Glad you could do it on such a short notice. It's kind of a day of situation, but
Did you guys ask him today?
this morning, yeah.
Was it this morning? Oh, yeah.
Yeah, you texted him.
Or yes.
Yeah, yesterday or today.
Yeah.
It's like 4 a.m, but yes. Yes.
That's right.
The day's
Practically
So
yesterday.
pretty much yesterday.
But anyways, so just for the listeners, what the heck is a whole life policy? And kind of what do you do? Not even necessarily just whole life policies, but what do you do in general?
So, great question. So, whole life insurance is a life insurance policy that will last you your whole life. It's essentially, you can. Well, there's lots of insurance for a lot of different things. You got homeowners insurance and auto insurance, and everybody's very familiar with those. The interesting thing about those, and I'll just dive in here, is, are you guaranteed to get in an auto accident?
No.
Mm-mm.
And did you know that there's about a 3% chance your house will get in a fire
Oh,
in
really?
your lifetime?
It's higher than I would have expected.
But there are a couple things that are guaranteed in life, and one of them is death.
Mm-hmm.
And
you
taxes.
can death and taxes. That's right. And you can quite literally take a life insurance policy that says, hey, when I die, because it's not a matter of if, like auto and home insurance, it's when I die, my family receives a payout. And of course, the earlier you start that, the better off that's going to be. The less expensive it's going to be. Or in other words, the more money that your family is going to receive when you die. And so you can do that at a very young age. You can actually take it out on infants if you want.
I apologize about that. We're trying to get a video for TikTok here, and we accidentally opened her up.
Anyway.
Infants.
Anyway, yeah, you can take policies on infants quite literally. So I've put policies on older individuals who are quite well into retirement and as young as infants. So you're guaranteed to die. It's just a matter of when.
And the government can't tax that, right?
Well, can't is a strong word. I will. I would say. Up to this point, it hasn't been taxed for over 2 centuries.
It's kind of like an IRA where
Crazy.
it's pre-tax or post-tax dollars, right? That you put in there.
So that would be a Roth that you're talking about.
Yeah.
Because there's 2 types of IRAs. There's a traditional IRA and a Roth IRA. A Roth IRA is money that's already been taxed going in. Therefore, when it comes out, there's no taxes on the gains or the distribution of it. Life insurance policy is a little bit different. There is a section in the IRS code that deals specifically with life insurance, and up to this point, to your point, Logan, it has been income tax free to the beneficiary for over 2 centuries. That's just how it is. Essentially, the way the IRS looks at it, or the way the government looks at it, is the money that you are contributing to the life insurance policy is going in with after-tax money. And essentially, the death benefit payout is looked at as the future value of that premium, and so therefore it comes out income tax free to the beneficiary. Yeah.
Okay, so say, obviously this isn't recommended, but say someone were to cancel their whole life policy and just take out their cash value, would that be taxed? Kind of like a 401k is, where it's like a 10% penalty or something?
No, it is taxed, yes, but not like a 401k because different rule, it completely different set of rules apply to it. So in that case, the taxation is going to be taxed as ordinary income, and it's taxed at the point of distribution or at the time of distribution. So let's say you got into it. Let's just hypothetically, let's throw some numbers out here. Let's say that you've put into it $100,000, and you cancel it when the policy value, and the value you're talking about is not the death benefit. You're talking about the equity or the cash value of the policy.
Right.
That distribution would come back to you as first in, first out, meaning you've put in $100,000, you would get that $100,000 back first. And then anything on top of that, let's say in this case, if you got $125,000 of equity or cash value, you would have $25,000 of gains. And it would be taxable as ordinary ordinary income in that year. Fast forward a few years, because these policies can aggressively gain a lot of equity. If you got a few $100,000 in there or $1 million of equity, but your cost basis is only, and I call it cost basis, that's the premium that you've put in. Let's say you put in $250,000 over the course of your lifetime, and you got $1 million of equity or cash value in there, and you cancel the policy. Yeah, you're going to have a $750,000 tax bill. Excuse me, not a $750,000 tax bill.
Income.
Taxable income of $750,000. However, because of the way you can use life insurance policies, you quite literally have access to all the equity, all $1 million of equity in this case that we're talking about, without ever incurring taxes whatsoever, because when you access the money as a loan, you're actually taking a loan from the insurance company, and you're putting up your equity as collateral.
And this is what we love about these policies, guys. We've mentioned them before, and they're freaking cool.
So quite literally, you have access to 100% of the equity in the policy, including the gains, because they're not realized gains because you haven't taken possession of them. So you have access to all that money, including the gains, as a loan from the insurance company. Because what they'll essentially do is whatever amount of equity you have in that policy, the insurance company basically says, hey, you know what? You have access to this money, our money, in the exact amount of equity that you have in your policy. And so you have access to that $1 million or the $250,000 or whatever amount of equity that you have in there. You've got access to that, and it's not a taxable event because it's a loan, and loans are not taxable. So you have access to it via a loan, and then when you pass away, the family receives the death benefit, again, income tax free. And upon your death, the loan, if you have one, is made whole at that point in time. So the insurance company would be paid back.
So they would just pay themselves back for the loan and then give the family the rest of the death benefit.
Correct. So if we're throwing some numbers out again, let's say you've got a $250,000 loan against your $1 million death benefit, and the insurance company pays out that death claim. They pay out that $1 million less the $250,000, because then it's that loan has been made whole. The insurance company has been paid back their money. The family receives a $750,000 net death benefit.
Income tax free.
Income tax free. Now here's the cool thing. What was the $250,000 used for that you borrowed?
Hopefully an investment.
Hopefully an investment. The insurance company has no idea what it is. But if it happens to be an investment, if you happen to have that $250,000 in, let's say, as equity in an investment, your family now has that $250,000 of equity inside the investment, and the $750,000 death benefit, net death benefit from the payout. So there's still $1 million that gets transferred to your family. So there's never loss of any value.
Yeah.
As long as you're using it for smart things.
Yeah.
Yeah.
Okay.
For sure.
So when you're, let's say, because we're kind of marketing to a younger crew, 14 to 30. What's
Sure.
the minimum you need to start a whole life policy, or the minimum you would recommend?
Great question. So because of the way we structure the policies, because of the way I structure the policies, I'm looking to max out the equity. Rather than focus on the death benefit, I'm looking to max out the equity of a policy, because you can use this policy as a personal banking system, which is exactly what we've been talking about. So essentially, in order to be effective as a personal banking system, okay, the recommendation is add a 0 to your age. So if you're 18, start with $180. Now, that's not going to be the minimum cost of insurance, because I'm trying to minimize the cost of insurance as low as possible so that we can max out the equity. Think of it kind of like a teeter-totter. You got on the one side, you got death benefit. The other side, you got equity. So I can structure the policy for death benefit, which minimizes the equity. I can structure the policy for equity, which minimizes the death benefit. And in the beginning, especially for younger individuals, it's better to do it that way, because if you maximize the equity and minimize the death benefit, I mean, the likelihood of you dying before 65 is, without there being like a freak accident or freak illness, it's fairly low. What's the likelihood of you dying after 65?
Starts increasing exponentially.
It's 100%.
Oh,
depending on your
when.
Yeah, it's just a matter of when. So, and I just I throw out 65 arbitrarily, but so if we structure the policy in the beginning years to maximize the equity, then you got the full use and enjoyment of that money throughout your lifetime to be used as a personal banking system. Now, again, don't get me wrong. This is not a banking system. It is a life insurance policy being used as a banking system. But you've got the use of that money to be, to access and to get you through life's expenses, and make investments and all that stuff. And then because of the way this policy is structured, the death benefit will continue to increase every single time you make a premium payment. And so you imagine we minimize the death benefit to begin with, and that death benefit is increasing year over year over year, so that when you're 65 and older, it gets to be quite substantial.
Mm-hmm. Okay.
Typically, when it's done right, a properly structured policy that's structured for equity will actually end up having a greater death benefit than one that was structured for death benefit initially.
That's just because they're purchasing death benefit each time they pay that equity.
Yep.
Pay the premium. Okay.
Yep.
What's the difference between term and whole life policy, just for everybody?
Yeah, good question. So term life insurance is essentially life insurance that is good for a specific amount of time, some term that's established, maybe a 10-year or 15-year, 20-year. Some of them even go as long as 30 years. And here's one way to look at it. When you buy term insurance, which term insurance is a great product, by the way. I sell a lot of term insurance. Great product. It serves a very specific purpose. And the reason it's such a good product is because you can buy a lot of death benefit for a very, very low outlay. And here's why. The insurance company will never sell a term policy that they think your family is going to cash in on. So
it makes sense for them.
Yeah, it certainly does. And so unless there's a freak accident or a freak illness, the insurance company wins, because when you get done with that term, that 10-year or that 20-year term or whatever, when you get done with that time frame, the insurance company says, "Thank you, have a nice day." You've essentially rented coverage for that period of time. Very, very appropriate, especially for young families. Job number one is to make sure the family's lifestyle is protected. So term is a very, very appropriate vehicle for that. Whole life, you're not going to outlive it. It's a matter of time before the insurance company writes that check, and they know that because it's a one-sided contract. So at any time you can cancel the policy, they can't. Anytime you can cancel the policy, and they'll return your equity, whatever that cash value, whatever amount that is. Or as long as you have that policy in place when you die, your family gets the death benefit. Term insurance is a little bit different. Like I said, you're kind of renting coverage versus whole life would be more like owning the coverage. It's actually considered an asset.
Okay. That's cool.
How do they make money though if they have to pay so much in death benefit towards everybody? You know what I mean?
Yeah. Yeah. So these insurance companies, most of them that I work with are well over 100 years old. Some of them are actually approaching the 2-century mark. They've got, thousands and thousands and thousands of bits of data to figure out the mortality expense of an individual. So they'll take an individual and they'll look at their lifestyle, they'll look at health history, they'll look at medications and medical records and all that stuff. And based on all the data that they've gathered over, coming up on 200 years, they can say with fair accuracy, hey, we anticipate you dying at this point in time. Like I said, unless there's a freak accident or a freak illness, your life expectancy is this, based on all of these factors that we've got on you. And so what they do then is they just price the death benefit accordingly. They say, well, if we anticipate you dying at this time, at this point in time, based on your age now, between now and when you're going to die, we need to collect X amount of premium for X amount of death benefit. Because we know that with the premium that we collect over this period of time, from now until the day you die, we know that we know with fair certainty that we can grow that premium to be, XYZ balance. And essentially, the reason life insurance, whole life insurance specifically, not some of the other variations of it, but specifically traditional, good old-fashioned whole life insurance is such a sustainable business concept, and the reason these companies have been in business for coming up on 2 centuries is because essentially the death benefit, if you think about it, just think about it this way: the death benefit is the future value of all of your premiums and what the insurance company knows they can grow that to.
Huh.
So as long as they've got their calculations correct, they say, okay, well, we're going to collect premiums from you for, 60 years or 40 years or 80 years or, depending on your age.
Right.
And when we go to pay it out, we know with certainty that all the premiums that we've collected plus what we've grown it to is going to be very close to what we've agreed to pay out.
That's crazy.
So unless there's a freak accident or freak illness, we're going to be about spot on. Does that make sense?
Yeah.
So how do they profit off that, or do they just profit off everyone else during the years and just? I mean, there's always going to be more customers.
No, these are private companies. They're for-profit companies.
Good.
And they've got that built into their equations, and
okay.
So and that being said, I mean, you see these policies and what they grow to. It's substantial. It's insane. Yeah. It really is. It's like, holy crap! How are they able to produce that much money and be profitable? Mm-hmm. But it's a sustainable business model that they've established, and they're some of the most conservative, some of the largest and some of the most conservative companies in the world are insurance companies.
I'm gonna have to look them up on the stock market.
Good luck.
Yeah, they're not there. They're private. They're publicly traded.
Well, okay, so let me talk about that for a minute. There are publicly traded insurance companies, and there are privately held insurance companies. The privately held companies are called mutual insurance companies, and those are actually the ones that I prefer to use.
Okay.
Because if you think of the motivation of the CEO, the president of the company, and the board of directors of any company, really, it's to provide a profit for the shareholders, for the stockholders, right? So of a publicly traded company, like you can own a share in XYZ insurance company, but doesn't mean you have to have a policy with them.
Mm-hmm.
Yeah.
You may not give a crap if that company's in business for longer than 10 years. All you want to do is make a 5-year profit.
Right.
That's why some of the insurance companies in 2008 took they took what is it? Speculative bets in that debacle that happened in 2008.
Mortgage-backed securities.
Mortgage-backed securities, you bet. And it hurt them bad. And some of them didn't make it through, but there was only a couple of them. They happened to be publicly traded companies. The mutual insurance companies are actually owned by the policy owners. That's the only way you can have ownership in a mutual insurance company is if you are a policyholder. So there again, thinking of the board of directors, the president, the CEO, rather than the motivation being, hey, how fast can we pump this stock? How fast can we pump profits for the next 5 years before we, get replaced as the CEO and the president? They're saying, how can we make this company last until every single policy owner is dead? So their motivation is very, very different. That's why specifically the mutual insurance companies are some of the most conservative companies in the world.
Okay, that makes more sense.
Because it isn't about being profitable or in business for 5 years or 10 years or 15 years. It's about being in business for 100 years.
Coming up on centuries now.
Yeah.
Jeez. Okay. So, if someone were to want to get a whole life policy, how would they contact you for that? Are you willing to give out that information?
Sure.
Here.
Yeah, absolutely. My email address is a little bit challenging, but I'm sure you guys can put that somewhere.
Yeah, we can link it.
On
Yeah.
the YouTube
You
video.
just
The,
text it to us or something, but
Yeah, my email address is nkelch@paradigmlife.net. My phone number, direct phone number right now is 801-382-8626.
awesome.
Perfect.
That'll be sweet. And then we've all got whole life policies through you, or are working on getting whole life policies through you. Probably gonna get some more, and so far they've been very awesome. Any complaints, questions, anything like that about those?
No. Not at all. Bit off more than I could chew at first, but
Yeah. Well, that's because you were
Ain't
trying
no
to pay
complaints.
extra premium, right? Trying to max it out. Just
it was maxed. Yeah, it was maxed out, right?
Yeah, initially it was, yeah.
Yeah.
yeah, that is
We'll
a
get
lot to chew.
back up there though.
Sure, absolutely. Well, the thing is, especially when you start the whole life policy, just because of mental conditioning, it feels like a payment, it hurts like a payment, and it feels like that money is going away bye-bye forever, just because of mental conditioning. In actuality, these life insurance policies, these specifically these whole life insurance policies, the way I structure them, they ought to be looked at as a long-term savings vehicle. Long-term meaning, plan on 10 years plus. And when you do that, after the first couple of years, the insurance, your equity in the insurance policy will start to grow by more than all the money you put into it each and every year. So let's hypothetically say you're putting $1,000 a month into it, $12,000 a year. After the first couple of years here, because there's obviously expenses to these policies, right? And the insurance company fronts all the expenses, and so the way they make those expenses up is in the first couple of years. There, they say, hey, you know what? A piece of your premium is going to recoup these expenses, more or less, and without getting too technical here. So after the first couple of years there, then the insurance company's motivation changes from, hey, we've got to recoup our expenses to, hey, we've got to grow this cash value to match the death benefit by maturity. What I mean by that is when you look at a whole life insurance contract, you remember how I was just saying a minute ago that the death benefit is essentially the future value of all of your premiums and what the insurance company knows they can grow it to?
Yeah.
So if you look at the whole life ledger there, the maturity date, and a lot of them now are like your age 121 years old. If you look at that, the cash value and the death benefit will be the exact same number.
Okay.
So the insurance company has to, by contract, make sure that cash value grows to match that death benefit by that period of time. So their motivation after the first couple of years of, once they recoup their costs, they say, okay, now we got to just plow this money into equity for this individual because we're going to pay it out to them eventually anyway. So we might as well grow their equity as much as possible.
Yeah.
So after the first couple of years, the expenses get out of the way. Then your equity will start growing by more than you put into it every single year for the rest of your life, which is a lot of fun. So going back to that example, you put $12,000 in, it might start growing by $14,000 per year. The next year you put another $12,000, might grow by $15,000, so on and so forth. You get a few years under it, you put $12,000 in, it could grow by $30,000 in that year. That's not uncommon.
Okay. Now, the real big question here is, I want to know the difference and pros and cons to universal whole life versus these are called mutual whole life policies, correct?
Mm-hmm.
Because as far as I understand, universal whole life can have very appealing numbers.
Absolutely, yeah.
So what's the difference between those pros and cons? Why the heck? Why would one go with a whole life policy rather than a universal whole life policy?
Great question. So it comes down to fundamentally the chassis of the policy, if you will. A whole life policy has guarantees, has specific contractual guarantees that must be met as a private contract. One of those being the cash value must equal the death benefit upon maturity.
Mm-hmm.
And so that being said, you have guaranteed growth every single year within the whole life insurance policy. Okay?
Mm-hmm.
The dividends that you receive with a whole life policy are based on the profits of the company. Remember I said with a mutual insurance company, you actually become an owner of that company.
Mm-hmm. So not only do you get growth in your policy, but you also get dividends beyond that.
Correct.
From the company.
Correct. You get dividends, you get profit sharing essentially. And that takes place in the form of dividends. So they pay that out to you. So those are just a couple of things there. With a universal life insurance policy, it's a hybrid. So I mentioned before the traditional whole life insurance policies have been around for about 2 centuries, a little over actually. The universal life policies were introduced back in the 70s and 80s to compete with the stock market essentially.
Oh boy.
And because the stock market was raging, because the interest rate environment is just crazy, everything was raging at that point in time.
Mm-hmm.
And so these insurance companies, they're brilliant, and they said, "Hey, how can we take advantage of this? How can we make these insurance policies compete with the stock market so that people will still want to buy them?" Because the guarantees of the whole life are, they're guarantees. That means through thick and thin, the insurance companies are on the hook for that. These universal life policies, not so much. So what they did is they cut all the ties. They come in with a completely different chassis. And in fact, the chassis that they use for those universal life policies is a 1-year renewable term. Okay, now I said a minute ago, I said the insurance company will never sell you a term policy that they think your family's going to cash in on.
Yeah.
And then they went and structured a whole, division, if you will, or a whole type of what's considered or what's treated like whole life, but they put it on a 1-year renewable term chassis. Okay.
That's shorter than term insurance.
Well, it is, but it renews every single year.
Okay.
Okay.
So what does that do on the side of the consumer?
So your costs go up every year.
Oh.
With a whole life policy, your costs will never change. If it's $1,000 a month for your premium,
mm-hmm.
it will never change from $1,000 a month. It doesn't matter how old you get. With a term policy, specifically with a 1-year renewable term policy,
mm-hmm.
the cost increases every year. So it's extremely affordable when you're young because, first of all, what are the chances of you dying within a year when you're young and healthy?
Not high.
So the higher the risk, the higher the cost with the universal.
But each year you grow close. You grow closer to the day you're going to die, and the insurance company knows that, and so they price it very, very reasonable when you're young, and the price goes up every year, and it's not usually a problem for a lot of years, because they're collecting whole life like premiums, right? But the cost of insurance is very low. And the idea there and how they're sold is, hey, you're never going to have to worry about the cost of insurance. Let me back up a little bit. If they tell you that your policy is based on a 1-year renewable term chassis, and they tell you that your premium is going to go up every year, those two things are very unlikely that they even disclose that, then they'll tell you, well, but don't even worry about the cost of insurance, because, you're throwing so much extra money at this to begin with, and this policy is going to grow so fast and so vigorously that you'll never even have to worry about the cost of insurance. But when you look at the guarantees on a universal life policy, every single one of them, without fail, are guaranteed to lapse. Because that's the only guarantee that the insurance companies can offer on those. They can't commit to them being in force for X number of years. Now, some of them will actually, get this, some of them will actually have a rider that you can add onto those universal life policies that will guarantee that they stay in force for X number of years, even if the cash value is gone. Why would they make that guarantee? Because it's highly likely your cash value is going to be gone. So they say, hey, for an extra amount of money, we'll still pay out your death benefit even if there's no cash value in this policy. But usually with those with that rider, then you have to, there's some, you can't ever miss a payment. You can't ever do this. You can't ever do that. You got to hop on one foot, pat your belly, and tap your head at the same time in order for the stars to line up for that to actually pay out.
Okay.
So essentially, when people ask me about it, I say, well, what's important to you about your life insurance? Like you're taking a life insurance policy. What's important to you about that policy? And they usually say, well, I want it to pay out my family when I'm gone. Are you? And then the next question is, are you willing to risk that? Is that up for negotiation? Are you okay with a maybe, or are you? No, I'm not okay with a maybe. This is a life insurance policy. I definitely want it to pay out.
Yeah.
Well, with the universal life policy, you're actually taking back on the risk that this policy will even be in force or not. What happens is, at the point that the costs exceed the equity, right? So the equity, the cost of the policy will essentially chew the cash value up. We've been talking about cash value or equity. The costs of the coverage, as it increases, will actually chew up the value of the equity, or it'll chew up the equity or the cash value. And because a lot of agents sell it as whole life, permanent whole life, which it's not, they sell it as if it is, though, and they talk about it. And the clients don't know, the consumer doesn't know, and so they buy it as a whole life policy. They never look at their statements. They don't ever look at the cash value. They don't ever look at that thing destroying itself or essentially eating itself alive from the inside out. And then until they get a letter, and that letter basically says, "Hey, Mr. Client, you have two options: A, fork up a whole bunch of money because your premium is through the roof now because you're old." And your premium's through the roof, and you don't have any cash value to support the premium. Or B, thank you, have a nice day. You don't have cash value, you don't have equity, you don't have a policy, you don't have death benefit, you walk away with nothing. You just rented coverage for this amount of time.
Jeez, so
It's a bad deal.
So as far as their cash value goes, do they just increase rapidly, spike, and then start eating away themselves and go down?
In theory, they're supposed to run up real quick and spike. But interestingly enough, the way I structure whole life policies,
Mm-hmm.
I have them perform like almost as well as those universal life policies are projected to perform.
Mm-hmm.
I can get a whole life policy to actually perform that well. And
it's guaranteed.
And you've got all the guarantees of the whole life. Yeah, exactly.
Yeah. And with the universal life, can you borrow against the cash value?
Yes.
You can.
Mm-hmm.
Okay.
Yeah, but there's another little twist with the universal life policies.
Of course.
There's two values there besides the death benefit. So you've got an account value and you've got a surrender value.
Mm-hmm.
Okay. So your account value is what you supposedly have in there. That's supposedly your equity.
Mm-hmm.
But your surrender value is what you will actually get out of it if you ever try to cancel the policy. So, that's the equivalent of saying, hey, you got $10,000 sitting over here.
Mm-hmm.
Okay, and then you say, okay, great, I want $10,000. And I said, whoa, wait a minute, whoa, don't be so hasty. You can only have $1,000. Wait a minute, but you just said I have $10,000. Yeah, you do have $10,000. It's right here. Well, okay, no. You get $1,000. That's what you can get. Okay, so how much money do you actually have? Do you have 10,000 or do you have 1,000?
Yeah, 1,000.
You got 1,000 because that's what you can get your hands on.
Mm-hmm. And with the whole life policies, the surrender value and the cash value are the same number.
They're the exact same number.
Okay.
No sleight of hands.
Yeah. Well, guys, with investing and with insurance and everything, we like guarantees.
Yes.
First rule of investing, don't lose money. Second rule, refer to rule number 1.
Absolutely. Now, with these life insurance policies, you heard me refer to them as a long-term savings vehicle.
Yeah.
Yep.
That's an important distinction there because it's important to have savings and investments.
Right.
So with the life insurance policy, priority number 1, protect the family's lifestyle. So make sure you got adequate death benefit. Number 2, build your reserves. And that can be done within a life insurance policy. And it's actually an extremely efficient place to put reserves because a reserve, some people call them emergency funds. Some people call them chaos hedges, rainy day funds. I like to call them reserves because I don't like chaos and I don't like emergency. I do like rainy days. I don't mind rainy day fund, but I prefer reserves. And so, an investor has got to have adequate reserves before they start deploying money into investments. In 2008, there were a ton of people who held themselves out as investors, both real estate and stock investors, and there were swaths of them that got wiped out. And it wasn't because of the downturn. It wasn't because the value of their properties, their value of their rental properties or whatever it was decreased in value. It's because they didn't have the reserves to last the storm. And so it wiped them out.
Tell you what we have going on right now, a lot of the same thing.
You bet. You look around, you can't hardly talk to anybody who doesn't hold themselves out as an investor.
Yep.
Because they got a Robinhood app or and any number of the apps that are out there. It's like, oh yeah, I'm an investor. Okay, what you invested in? Oh, I'm invested in crypto. Okay, how long you been doing? Oh, I just did it last week, and I'm already up, $200, $300. I'm an investor. It's like, oh boy,
I'm leaving the room.
You're a gambler. Anyway,
I know.
That's a whole different. That's a different topic, but it's essential that you've got reserves. And then above and beyond the reserves, that's when you start dipping into your opportunity fund or start building your opportunity fund. There's another misconception is a lot of people go out there with their hands out thinking, oh, if I just won the lottery or if XYZ opportunity fell in my lap like it did so-and-so other,
If this $1,000 turned into $1 million like I've been told it could.
Yeah. Then I got it made in the shade and it's like, hey, dummy, build your opportunity fund. Because when you have opportunity funds, if you don't, you're walking around with an empty cup, what are you going to get more of? Emptiness. Mm-hmm. You put money in your own bucket first. Build your opportunity fund, and I promise you, this is a promise. You build an opportunity fund, opportunities will seek you out because you created a vacuum. It has to be filled. So it's important to have your reserves. It's important to have your life insurance. That would be your long-term savings vehicle. It's important to have investments as well. So as you build up your opportunity fund, like we talked about before, you now have access to that money via a policy loan to deploy that in an investment. Mm-hmm. The cool thing is, because you're not taking your money out, it continues to grow on a compounded basis, uninterrupted.
And these loans are fairly cheap, aren't they, as far as hard money loans go?
Oh, geez.
Because they're 100% backed.
It's not even comparable to a hard money loan. Yeah.
Yeah.
Because, it's so cool. Yeah, it's currently about 5%.
And does that fluctuate very much?
No.
Okay.
No. I haven't seen them fluctuate in well over, 7 years.
Okay.
Haven't moved.
And the markets have been doing crazy things in that time.
Oh, absolutely.
And everything else around them. But I guess like the rest of the company, it's just stable and conservative.
Well, there again, it goes back to, hey, why would we charge you more as an owner of this company? Why would we charge you more than we absolutely have to? Because what are we going to do with all that money that we charge you?
Couldn't pay it back out.
As an owner of the company, we pay it right back to you.
Mm-hmm.
So it doesn't make any sense. So, yeah, they keep that loan rate as low as possible.
So a lot of people believe in the 401ks quite a bit. So why should someone get a whole life instead of a 401k?
Also, can you please speak on IRAs? IRAs, I don't know a whole ton about, both Roth and regular. Okay. I know it's a big conversation, but we got time. If you've got the time.
Yeah. So, great question. So, just real quick for your clarification, a 401k is in layman. I'm going to put this in layman's terms. A 401k is essentially an employer sponsored retirement plan. So, as an employer, I'm going to set this up for my employees, and I'm going to contribute it. I may or may not contribute to it. The employee can contribute to it. If you contribute to it, I might match it as the employer, so on and so forth. An IRA.
Now, can you pause on that 401k idea? From what I've heard from some successful investors, they say if your employer provides a 401k match, then max out that match. At the very minimum, max out that match, because even if you do have to take that, we'll say the cash value out of it early and take that hit, you're still going to be have a lot more money than you would have, right? Would you think that's a good idea?
Yeah, I typically recommend
max it out.
I typically recommend individuals put enough money in there to get the match.
Yeah, that's what I'm saying. Max it out to the match.
Yes,
is what I'm saying.
Yeah, max it out to get the match. Yeah, absolutely. There's no reason. Well, there are
free
some
money
reasons,
essentially, right?
Yes. Yeah.
So why wouldn't someone do that?
Well, it's typically a good idea to do that.
Okay.
Okay. An IRA is an individual retirement account. So instead of an employer putting that together for you, you do it yourself, which is individual. But other than that,
same product almost.
Other than that, yeah, you can. Yeah. I mean, there are they do each have their own rules and stuff like that. But without getting too technical with it, an IRA is something that you set up as an individual. A 401k is something that your employer sets up for you.
Okay.
Otherwise, you both have in either of them, you've got two variations. You've got the traditional or pre-tax, and you've got Roth. So you've got Roth 401ks, Roth IRAs. You've got traditional IRAs, traditional 401ks. The traditional is essentially pre-tax, which means you pull out money or they pull out money before you get taxed. Okay?
Okay.
So you're essentially postponing the taxation on that traditional type of account, where a Roth 401k or an IRA is, I'm going to get taxed on it, and then I'm putting it into this retirement plan. Okay?
So that your gains aren't taxed when you.
So that your gains aren't taxed. Yep, that's right. To answer your question, Logan, why would you do a life insurance policy instead of a 401k or an IRA? There are two completely different types of financial tools. Remember, the life insurance policy is a long-term savings vehicle. You know, a savings vehicle, and this is you bring up a good question there, because we can make a distinction here. I call life insurance policies a long-term savings vehicle, simply because when you put money in a savings account or a savings vehicle, and you don't even think about that for a whole year or 10 years or whatever, and you come back to that account, would you expect, with reasonable certainty, that you would have all of your money there, maybe even just a teeny bit of interest?
Yeah.
Mm-hmm.
Now let's talk about an investment. In an investment, if you plow a bunch of money into an investment and you walk away from it for a year or 10 years and you come back to it, what's the likelihood that you're going to have all of your money there plus a little bit of interest?
Not likely, right?
Depends,
Not
I
as
guess.
much as-
Yeah,
Depends on the investment.
yeah.
Yeah.
Both answers could be correct. It totally depends. So investments all carry risk. And that risk is that value can and does evaporate. Okay? Take 2008 for instance. I had a 401k in 2008. I woke up one day and 40% of it was gone. It had evaporated. Okay? A lot of people experience that with real estate. Same thing. 40% of the value or 50% or whatever percent of the value was gone. So real estate is an investment. 401ks and IRAs are investments. Okay? They're talked about as retirement savings vehicles.
Yeah, they
Yeah.
are.
That, besides the language, that's a bullcrap lie.
You're okay to
Oh, you
swear.
can swear. We're
Oh,
good.
sweet. That's a
Yeah.
bullshit lie.
Yeah.
Okay?
Yes.
But for a couple of different reasons. First of all, if I asked you 5 years ago what would be happening today,
You don't know.
I have no freaking clue. There is no way you could have predicted what's happening in our life today.
Freaking pandemic.
Yeah.
Who'd have thought?
Yeah. No possible way.
Mm-hmm.
Okay. It was what's considered a black swan event. The thing is there are multiple black swan events in our lifetimes. I mean, in you guys' lifetime, you remember 9/11. That was a black swan event, and then this pandemic that shut down the world economy. So retirement is something that's supposed to be off when you're 65 or 70 years old. For you guys, that's like 40 years away, 50 years away. How are you supposed to plan for something that's 50 years away?
Can't.
So the typical approach is, hey, throw a bunch of money in a 401k or an IRA, hope and pray that in 50 years from now, you can actually stop doing a job that you hate doing and live the life that you want to live. Yeah, good luck, Chuck. That's idiotic. That's just freaking insane. Yeah.
Don't get him started.
For reals. Anyway, but it is important to have investments too, right? And don't get me wrong, I love hopes and prayers. Okay, amazing for Sunday, not so amazing for financial plans.
Fair enough.
So you want some certainty to your financial plan, so you take control of it yourself. Like I said, you build the reserves, you build the opportunity fund, you go find opportunities that are going to create value for you. And Logan, you asked me that question, what might drive me or what might interest me as an investment might be something totally different than what might interest you. And so, there was a guy called Robert Kiyosaki. You guys are all familiar with him.
Oh yeah.
Robert
Rich Dad,
Kiyosaki.
Poor Dad.
Rich Dad, Poor Dad, yeah.
Mm-hmm.
And I believe it was him who said there are no good or bad investments. There are only good or bad investors. And the difference between what makes a good, like a good investor versus what I call a gambler, I call it, hey, you want to go gamble on buying a house, or you want to go gamble on stocks, or do you want to be an investor? Is education. What degree of certainty do you have that that investment that you're taking on is actually going to be profitable? Well, what typically makes that determination is how much knowledge do you have on it. Right. So it's important to have, I know I'm kind of going off on a tangent here, but it's important to have investments. It's important to, have your 401k, have your IRA. Those are simply financial tools. I don't personally care for them because you're plowing money into something that at the whim of the government's, whatever they're wanting to do, they just wave their little magic wand and take more of that money.
Your fees go up.
Well, because IRA and 401k, they're created by the IRS. Well, when's the IRS ever done anything in your favor over theirs?
Never.
Yeah. Again, good luck, Chuck. And so quite literally in 2018, they said, hey, you know what? We want more money. They changed the rules a little bit. And a huge amount of wealth that would have gone to heirs and beneficiaries of 401ks and IRAs as inherited IRAs and 401ks got eliminated. Now all of that money has to be distributed within 10 years. Instead of being stretched over a 25 or a 30-year period, it has to be distributed within 10 years. Well, what does that do to your income? Drives it way, way up. And what does that do to the government?
High.
Bingo. It increases everybody's tax bracket. Government gets more of the money. And they can do that anytime they want. So to your question, why would somebody do a life insurance policy instead of a 401k or an IRA? Well, who do you want to be in control? Who do you want to be in the driver's seat? Do you want you to be in the driver's seat, or do you want the government to be in the driver's seat?
Yeah, you.
And again, you're not a partial owner of the government.
Yeah.
No. Yeah. Again, sorry. Anyway. So if you've got a 401k and you've got a match, get the match. Why would you postpone paying taxes on any more money than you have to get that match? Mm-hmm. I mean, based on the government's spending appetite, last I checked, they're trillions over their budget every single year. You think taxes are going up or down?
Oh, they're going to go up.
So anytime you put money in a traditional 401k or an IRA, you're postponing paying the taxes. So, if you were going to pay 10% or 12%, or 22%, whatever the tax rates are today, instead of paying 22 cents on the dollar today, you're postponing paying the taxes. You might pay 35 cents a dollar on the dollar, when you actually take that money out. That's a huge gain for the government.
You'll also likely have less write-offs at that age. Your kids won't be in the house. You'll have less dependents. You may or may not have. Do you have a homeowner's write-off that you can do?
Depends on if you itemize, yeah.
Okay. So, there's a bunch of stuff that you won't be able to write off at that age either, potentially.
Yeah.
So you have zero access to it until you're, 65 or 70?
Oh, you
whatever.
can have access.
59 and a half is when you,
for now.
The government is very generous in that they give you, it used to be 11 years. Between 59 and a half and 70. Is that 11 years? Yeah, about 11 years.
Yeah.
They've extended it to 13 years. Now you can have your 401ks and your IRAs, and you get full use and enjoyment of your money for 13 years without fear of penalties. Congratulations.
And then what?
So if you pulled out after you're 70 or whatever, you get penalized too?
If you don't pull enough, you get taxed at 50. Quite literally, you'll get taxed at 50% of what you should have pulled out. Because remember, you postponed paying taxes for all those years. Now the government come a-calling. They say, "Hey, we want our money now." You're hanging on to their money. A lot of people don't understand that. They say, "Oh, well," I ask them, because I talk to people about their finances all the time. I ask them, "Oh, how much money do you have in your 401k or an IRA?" "Oh, yeah, I've got $100,000. I got $150,000." I ask them, "Well, how much of that money is yours?" "Well, $150,000."
No.
"Are you sure? Have you tried pulling it out?" There, going back to how much money can you get? Well, that depends. Depends on how you pull it out. Depends on how old you are. Depends on all these different things. It's like, ugh, yeah.
So you have 13 years to spend it all, and if you don't, you just get
No.
Or-
You've got 13 years without fear of penalty. So if you touch that money before 59 and a half years old, you're going to get a 10% penalty for early access.
Besides the taxes.
Oh, yeah. Well, taxes isn't a penalty.
Oh, right.
That's just taxes. That's their money.
Right.
That's Uncle Sam's money you're hanging on to. So you're going to pay the taxes no matter what. But if you access the money before 59 and a half, you're going to get a 10% early withdrawal penalty. And if you don't take the money out after they just extended it to age 72, if you don't take your money out, then you get taxed for 50% of what you should have taken out.
Okay. It's terrible.
It is terrible. So anyway, going back to the savings and investment, it's important to have both. 401ks and IRAs, they're simply an investment. Okay? You can, I mean, and quite literally where 401ks and IRAs are typically invested is stocks and bonds. You can do that in a brokerage account too. You don't have to have it inside of a 401k or an IRA.
You have more control, by the way.
Oh yeah, you got full control and no penalties.
Just your regular taxes, I suppose.
Yeah.
Or capital gains.
Well,
Regular income or long-term capital gains. That's what it is.
it's actually tax advantaged to own it outside of a 401k or an IRA because all income inside of a 401k or an IRA is taxed as ordinary income. You just bring up a point. If you hang on to a stock for over a year, it's considered long-term capital gains, which is typically a lower tax rate than ordinary income. So you can literally you can buy a Tesla. Let's just use Tesla. Everybody knows what Tesla is. You can buy Tesla inside your 401k or an IRA. You can buy Tesla outside of your 401k or an IRA. And you run it up for 20 years. The one you bought outside, you might get taxed at 10 or 15%. The one you ran inside, well, that depends on your tax rate.
Jeez. Teslas, by the way, have a lot of tax write-offs, turns out. Like, you got a bunch of electric vehicle write-offs. You got
the Tesla owners?
Like, yeah, if you own an actual Tesla car, you've got a lot of incentives to do so.
Oh, sure.
Very interesting.
Yeah.
Just learned that.
It's that's a whole nother tangent.
I want one just for the self-driving. That's all.
They're
I
pretty
want.
cool, actually. I like the look of them and everything.
Couldn't care less
You
about
can
that.
buy it for like 30 to 40.
Couldn't even care for the
cheaper
electric
ones.
vehicle part. I just want something that I don't have to touch the wheel hardly. That'd be perfect.
Yeah.
Yeah.
See people
So
doing
nice.
their makeup or literally sacked out.
Yeah, on their
the
phone.
hell?
Just like phone laws are going to be interesting. They're going to have to change a little bit about phones in the roads with self-driving cars coming out.
I doubt they will.
No, government
For a
never
while.
gives up anything. They only add more laws.
I haven't run across a Tesla that I'd really care to own yet.
They don't look good.
They
I
have
don't,
new
I don't
models
love the look
coming
of them,
out.
but just the self-driving. The what?
They have a new model coming out that's just so good looking.
I want to start looking at like
It's like a Porsche on
the other
steroids.
electric vehicles, some China-made ones or something. I don't know. We'll see. Neo.
It's for the economy, but it's worse, actually.
Yeah, but Tesla's a bubble right now, so there you go. And they just bought $1.5 billion in Bitcoin. Yeah.
44K per coin now.
Well, the thing with the electric vehicles, all these dipshits going around virtue signaling that they have a clean car. It's like,
Oh, yeah.
well, what do you think it took to produce the materials to build the car? What do you
It's the
think it took
lithium batteries.
to produce
Yeah.
the batteries?
Yeah.
You know, what about the mining and the everything that went into getting that?
Mm-hmm.
And you know, and how the hell do you think your electricity is produced to put in your stupid electric car so that you can virtual signal that you have a clean car?
Yeah.
You dipshit. just stop. You know?
I did see one interesting thing. It was like you're giving up men mining coal for children mining lithium and wherever, and it showed the different mines. It's just like, yep, not wrong.
Yeah.
Very interesting.
Yeah, I'll tell you, I'll tell you, and it doesn't have a whole lot of backing on it yet, but hydrogen for a clean fuel.
Yeah.
Once they can figure out how to make that profitable, let me retract that. Not profitable. Once they can make that technology produce more energy than it takes to create, that's an awesome clean energy, and I get
Just
behind
water.
that one. Yeah.
And you could even use salt water because that's technically can hold a lot more electrical charge.
Yeah, the byproduct, the emissions from a hydrogen engine is
Oxygen.
water and oxygen. That's it.
Ooh.
Yeah. So that's a clean energy that I'd love to get behind.
There's actually I think it's fuel cell energy that is actually working on hydrogen power.
There's actually a few companies that do it, and I think Canada is one of the front runners on it, if you will. They've got a lot of buses and things like that run off hydrogen energy.
No kidding.
But again, it still takes a lot to produce the hydrogen,
Right.
to create the hydrogen. So
Still needs some sort of gas in there, like a hybrid thing maybe. Can't run solely off water for now.
I think the technology isn't quite there yet.
Yeah.
So I think we're headed in the right direction with our like the motivation is pure. Let's get clean energy,
Yeah.
That the motivation is pure, but the virtue signaling and the cost, like all electric stuff, like
So
all this electric,
expensive.
well, it's all subsidized. If it wasn't subsidized, the cost of the vehicles, the cost of everything would be through the friggin' roof.
Mm-hmm.
It would be as funny as ever. We got a neighbor with a clean car, a Nissan Leaf, or had a Nissan Leaf. I don't know what they've got now, but anyway, funny as ever. They pulled up to us right after they got this car, okay, and they're like, "Hey, do you like our car? It doesn't cost us anything to run. Doesn't cost us anything because we can just charge it at our house." And I look over at their house, and they had just installed $20,000 worth of solar panels.
And bought this however many $1,000
Yeah,
car.
it's like, well, congratulate. I mean, of course,
Yeah. Oh my gosh. Good
No,
job.
I just say, hey, congratulations, and I'm real happy for you, all that good stuff. But it's like, I'm looking at their house, I'm thinking, okay, you just spent, however much, you spend as much as a big old massive diesel truck would cost to buy this little, or to drive this little piece of shit
Electric car.
electric car. It's like, dude,
Yeah.
you go, you do you,
That
boo.
you have to charge for hours or days to get a full charge from solar panels.
Yeah. Well, that's the thing. You drive down to St. George there. What is about 275, 300 miles there
Yeah.
from Salt Lake. And they have a stop in Beaver, a gas station in Beaver that supports those Tesla,
Yeah.
supports the electric cars. And every time we go past there, they're all full of electric cars sitting there getting charged. And the owner is sitting in their car because they have to kill time while their car charges so that they can go the rest of the way. It's like, no, I'll gas and go for now.
Yeah. Yeah. Until you can make it that fast, it'll be sweet. Supposedly the Tesla truck that's coming out is supposed to be like 400 miles, isn't it? Something like that.
Yeah, if you get the expensive one, it was 400 miles.
They're so ugly though.
Well,
Dude,
I like
I
them.
want
The more I
them to
look at
make
it, the
it-
more they grow on me.
I want them to
It
make
looks so
that and do a
stupid.
freaking Halo Warthog. Give me that.
Actually,
Okay.
it's funny you
That'd
said
be
that.
so cool.
That'd be sick.
Microsoft or the people who made Halo are actually contacting
Elon Musk?
Yeah,
Yes.
to make a Warthog.
I won't be able to afford it,
Make a
but
Banshee.
that'd be the coolest thing ever.
You're sick.
I mean, just like his not a flamethrower thing. I was watching his Joe Rogan podcast.
Yeah.
And he's like, yeah, I sold these hats and made $1 million off of 50,000 hats. And so we said, hey, how many flamethrowers or how many not a flamethrowers do we have to sell to make $1 million? 20,000. And we sold them in 3 days. It's like, dude, you're wild. He's like, yeah, it's actually just like a torch with a rifle casing. And
Yeah.
sold out of them in 3 days. I'm like, holy sh.
A lot of people went to jail for
Genius.
those.
Did they
Really?
Really?
Yeah, because they're considered a
flamethrower.
Well, yeah, they considered him a flamethrower or a gun or some
Yeah.
stupid ass thing. So all these libtard countries that we have all around the world, they would throw people in jail for owning those.
Yeah, he said he was able to ship it internationally because he called it not a flamethrower. Because it's not a flamethrower.
Right.
That's how they got past the commissions or Security and Exchange Commission, something like that, and called it not a flamethrower. But that is insane that they went to jail for it.
Yeah.
It's wild. Elon, my boy, I grew a new love
It's a
for him.
dangerous weapon.
Oh yes, I grew a new love for him after I watched that podcast. I gotta admit,
It's a way entertaining podcast.
He's an interesting
he's an entertaining
person.
man.
Yeah.
He's just like, yeah, my brain, it doesn't stop. He's all depressed and stuff that his brain doesn't stop coming up with ideas. It's funny as heck.
That's funny. If you watch that live and he's smoking his weed, such a fun
Yeah,
video.
and he's like, he looks at his phone. All people are freaking out on me for smoking weed. I don't care. I like it.
He exploited a lot of loopholes. A lot of. I mean, they're legal,
Mm-hmm.
but he got a lot of funding for his for Tesla and for his projects
Mm-hmm.
through government subsidy.
No kidding.
Oh, yeah.
Okay. I believe it. And now he is officially the richest man in the world for
Yep.
now.
Oh, is he?
Yep.
This week?
No, it was 2-3 weeks ago. But yes, for now.
For now, yeah.
Till that Tesla bubble pops, and then the reality might set in a little more.
Won't affect him. He's so wealthy, or just whatever.
I mean, just the way that he thinks is freaking genius. He was saying that. I mean, it seems like people just say yes to him, governments and stuff, and I wonder if it's just because he's close with a lot of them like that. But he said, "Yeah, I wanted to dig this tunnel under was it San Francisco or L.A."
Something like that.
L.A. I think it was L.A.
Yeah, he said, "I want to dig this tunnel under L.A. so that we can start doing traffic underground because you've got 3D, you got infinite space, down
Mhm.
to 4,000 feet, whatever." He wants to do 100 levels.
Oh, geez.
Yeah, he says they're very earthquake safe, all this jazz, because earthquakes are mostly a surface event, yada yada. Anyway, so he was like, "Yeah, they didn't want me to dig a tunnel, so I just asked if we could dig a hole, and we dug a big old hole 3 to 4 days, and then we made it into a tunnel." And they like it. So that was just a side business. It was pretty fun.
So his most valuable asset is not Tesla.
It's his brain.
It's his brain. It's
He's
his
a wild
intellect.
man.
And that goes for, going back to this life insurance bit. Everybody protects their what they consider assets. Cars are not assets. They're depreciating liabilities. If you think of an asset as anything that puts money in your pocket, and a liability is anything that takes money out of your pocket, a car, never an asset.
Mhm.
Unless it's some antique or something like that, and it's actually increasing value.
Actually appreciating, yeah.
It's actually appreciating, yeah. Homes, a lot of people think of their primary residence as an asset. No, that's a liability. A rental home is an asset because that actually puts money in your pocket. Your intellect and specifically your ability to create value for others is your most valuable asset.
So you'd say eating healthy is investing in yourself,
Absolutely.
basically, like it's an asset.
Mm-hmm. Well, it's investing in yourself and your well-being. Yeah, absolutely.
Where's he going?
Same with working out and all that stuff.
Yeah.
Just
Yeah,
taking
absolutely.
care of yourself.
Well, the thing is you got to have a balance in life in all areas of your life. If you're lacking in one area of your life, it has an effect. There's a ripple effect in all other areas of your life. So, if you eat real healthy but you never work out, and your finances are in the shit, and your relationships are in the crapple, and your spiritual life is in the dumps, what good is eating healthy?
Yeah.
So yeah, it's absolutely important to your point, Logan. It's absolutely important to work out, stay fit, Zave, to eat healthy like you're talking about. Make sure your relationships are nurtured and get plenty of attention and things like that, and all aspects of your life. Yeah.
So fun, you would calculate fun in that whole realm of needing. Well, yeah. I don't know how to word that better. But
Like vacationing? Or
yeah,
what?
like taking time off and not working so much because you kind of
Absolutely.
need to budget that into your time.
Absolutely. It is vital that you take time out for yourself and to take time out for breaks. Yeah, if you're hard on the paint all the time, you're going to get burnout. So, absolutely, take vacations.
Do you have any good books to recommend that you would recommend about whole life policies?
Jeez. Depends
Or
on
we could
where
say finance in general.
finance in general, whole life policies. So I would say just a fantastic mindset book is Richest Man in Babylon.
Yes.
It's
one of our favorites.
Yep, we
That is
recommend.
hands down one of the best mindset books, financial mindset books there is. A fabulous book about whole life specifically is by Patrick Donohoe. He's the CEO of Paradigm Life, and he wrote a book called Heads I Win, Tails You Lose. And it actually gets into detail about 401ks and IRAs and life insurance policies as well. And he's got I thought it was a very well-written book because he brings a lot of his experience into that book and ways that he's used his policies and throughout his life. And he's an investor. He's an entrepreneur, an investor, a business owner. And he talks about some of the challenges that he's gone through and also how he used the life insurance policies in his own life as well. And it gets into details about how we structure the policies specifically for the equity rather than the death benefit, so on and so forth. So, yeah, that's a really, really good one for, if you want to know more about life insurance.
Perfect.
Okay. And I had a question going back. I know this is like way back far in the podcast, but when you're talking about building up a reserve and then building an opportunity fund, how much of a reserve would you need to start with before you start, accruing an opportunity fund? Maybe like 3 months? 3 months of reserves, or?
I would say at a minimum, at an absolute minimum, 3 months. And it's going to be 3 months of expenses. Not 3 months of income, but 3 months of expenses. I would say that at a minimum, preferably 6 to 24 months, depending on how secure your job is.
Okay.
And then that's going to be personal, and then family. Like going out from a core, it'd be personal expenses, and then you expand that out to family expenses. So if you're married with kids, it's going to be different than if you're single. And then extend that out again. If you're a business owner, make sure you've got adequate reserves for your business. If you're an investor, make sure you've got adequate reserves for the investments that you've got. Again, going back to 2008, that's what wiped a lot of people out. It was simply just not having the adequate reserves. So, nobody expected this pandemic to last for, how long are we into this pandemic now?
Almost a year.
Almost a year.
It's only 2 weeks. Don't worry about it.
Yeah. Let's just shut the economy down for a couple of weeks, and this whole thing is going to blow over. And here we are a year later, and we're still going strong. And I just read a report this morning, and excuse me, President Biden said that
Well, that feels weird.
Sleepy Joe.
President Biden? Anyways, sorry.
Well,
It just felt weird to say.
I know.
Weird to hear it.
Well,
But it's the reality.
It
Accept it.
Yes.
it felt weird to say it. Not gonna lie, but it is what it is. If he is the elected president of the United States, then I'm gonna call him
He's President Joe.
Yeah, I know.
President.
I respect. I'm just saying it felt weird to hear it because I haven't heard that yet.
After saying Daddy Trump so many times.
Yes, Papa Trump.
But anyway, Sleepy Joe says that we may not be into herd immunity until late summer, maybe, if we're lucky.
Right.
Which-
And that's if everyone's getting these vaccines that are supposedly coming out sometime
That make
soonish.
your face droopy.
Yeah.
Yeah.
Yeah. Well, they're doing all the medical facilities personnel right now, and I've I know a couple people who have gotten it, and they were fine. They were sick, but they were fine.
There's a guy I
pass.
game with.
Agreed.
His coworker's dad got the vaccine and then died
From what?
from the vaccine.
From COVID, dog.
Like he got the vaccine and died.
And died from the vaccine.
Yeah. After he got the vaccine, died. Dead.
Got to be stronger.
Yep.
I read a report, wise on their part because they can get away with anything they want, but they said that they were purposefully not tracking the side effects of these COVID vaccines. They give the pharmaceutical companies a free pass on any liability when it comes to vaccines.
They
It's
had
interesting.
emergency approval.
I
This
believe
is
it.
real? Like,
Yeah.
they're not even taking data on...
That's what they said. So they're like specifically, purposefully not taking data on the side effects of the COVID vaccine.
That's ridiculous. That's so ridiculous.
Well, generally a vaccine will take a year or two to get FDA approval.
Oh,
and they got
geez.
emergency approval
Way
in
longer.
weeks.
Like
Yeah.
10 years.
Oh, no
Yes.
kidding?
Yeah,
Oh,
it's,
okay.
it's way long.
But they got emergency approval, and it's a new kind of vaccine that actually messes with your DNA to produce these antibodies.
Yeah, no thanks.
Plus, you can't
Good.
even cure a virus, right? Doesn't it have to like
Your body
its
can
course?
fight it.
go through
but yeah.
something.
Yeah. Viruses have to run their course based on. I mean, I'm no medical expert.
Just common sense. Wear 3 masks, 4 or 5. It doesn't matter.
Yeah, I'm no medical expert, but last I've heard or read or seen or all of the above actually, a virus has to run its course. So
Doesn't leave.
Over half of Utah has had COVID as well. Half of Utahns.
There you go. So now we
No
don't got to
herd
worry about
immunity
it.
though.
yeah,
Silly gooses.
interesting times we live in, boys.
Same thing. It's Schrodinger's virus.
Huh?
It's called. Well, this is what it was first called when it was coming out. Not officially called, but people were referring to it as Schrodinger's virus because Schrodinger did an experiment. It was Schrodinger's cat. He said, "Put this cat in a box, close the lid," and he said, "You don't know if the cat's alive or dead while that box is closed. So how do you know? How do you know what to do with the box? Essentially." So he said, if you can't see it, you can't hear it, you can't feel it, then you have no clue whether it's alive or dead. So this COVID virus, you can't hear it, can't see it, can't feel it. You have to wear a mask as if you are sick, whether or not you are sick. You have to act as if you are sick. So it's Schrodinger's virus. You have no clue, but you have to act as if. It's
Okay.
crazy. Yeah.
Not only that,
I
but
tried to explain why it's called Schrodinger's
Yes,
virus.
I understand. It's just
Yeah.
weird.
not only that, but you've also got to assume that everybody else is a deadly virus waiting to attack you.
Yeah.
You're literally,
Some classic fear mongering.
oh geez, you're literally, everything that walks and breathes that you can see and that you can't see is ready to jump down your throat and kill
And
you.
obesity has a better chance of killing you.
Oh my laws!
Or heart
Suicide.
disease or suicide. Yeah.
Actually, this COVID pandemic has been extremely deadly. It killed off cancer and heart disease, the flu virus, colds and flus.
All of it's
They're
dead.
extinct. Everything else is dead except for, I mean, even car wrecks have gone extinct. Everything's COVID now.
Smoking's no longer a problem.
What?
What's that? Never heard.
Yeah, it's been aggressive.
Yeah.
But with that, we should probably wrap up. We'll have to
Yeah.
talk to you about some of your other experiences another time because I know you've got a lot of life experience outside of whole life policies and such as that.
Yes. Could be hours
Be
long.
very interesting for the listeners.
You want me to keep
hear.
it 20 words or less?
Yes.
So we'll put your contact information. We'll get that phone number and the email and put it on the link to the video
And the books.
and the books. Yes. And then as far as we go, make sure to like, subscribe, hit that notification bell, and then
Comment. Yeah,
comment,
that's our new
please.
algorithm.
Please comment, and then check out our Patreon page. We'll link that. Email us with any questions, all that jazz. Check out our merch. It's pretty sweet. We're actually getting some in for our 1 year anniversary in April.
Yep.
That's crazy.
Got some hoodies for each member. It'll be nice.
Coming up on a year already.
Oh yeah,
April.
in
you guys?
April.
April.
April,
Yeah.
is that since we started the podcast or the
No.
actual group again?
That's when we restarted the group. Yeah.
Mm-hmm.
Before that, we ended it in December of the year before.
Jeez.
That was the last Discord chat we had. It was from Jesse. He said, "When's our next meeting?"
Oof.
Nothing.
Feels bad.
Yep.
Cool.
Alrighty.
Well,
thank you
appreciate you
for
guys
showing
having
up.
me on.
Yeah. Thank
yeah.
you.
For coming on.
Appreciate it.
And next week, for the listeners, we are doing a podcast on outwitting the devil.
Yeah.
Yes.
That's
See
a
you
good book.
Oh yeah, it is.
All right.
See you guys next week.
Toodles.
See ya.